Folks, if you've been following Jonathan Twombly and I's discussion, you know one thing for sure. We are both conservative investors who sold before this last little run up. Both of us sold properties in 18 and 19 because we thought things were getting away from us. The pandemic obviously took cap rates even lower, which means in theory we sold early. But we've been warning you for the last year about the pain is coming. We have done videos where we've taken $100 million properties and turned them into 28, 32, $40 million properties. We took a billionaire to zero and below. It is now obvious that our concern might be understated. There is $1 trillion in multifamily refinances coming up in the next 4 years. There is $2.6 trillion in all of commercial coming up in the next 4 or 5 years. Folks, that debt needs to be refied. Also, new transactions. It could get ugly. Jonathan, what's going on? How you doing?
I mean, gosh, with that intro, listen, there is a lot of debt that is about to mature. And the reason that there's so much debt maturing, some of this is short-term debt that can't, that is from the pandemic era, right?
Mm-hmm.
And some of it is a little bit longer term debt. So, these things will behave a little bit differently, really, depending on when it was purchased. But let's, look at so the real problem for almost everybody in that group of maturing debt is that interest rates are much higher than they were when they got their
And
original
going
debt,
higher.
and going higher. Yes, right. So
Yes.
which means that when let's put aside for a moment whether the banks are going to have the same appetite to refi, right?
Mm-hmm.
To issue new loans that they did when they first issued the original loans. That's a different
Correct.
issue. Even
Correct.
just assuming that all of those loans are there's appetite for them all to roll over, the interest rates are going to be much higher. And that's going to mean that some of those deals are going to require cash in refi because the equity
Get
will
used to
have.
that term, cash in
Yep.
refi. It's going to be very common. We are now having more and more syndications do equity call outs, right? Equity raises. It's just starting. And boy, if you got to do an equity raise, let me tell you, be first, don't be fifth, because your LPs are going to get really tired of those phone calls.
So, listen, there's a lot of things that are happening here. First of all, I think one thing that people need to understand is that when you purchase a multifamily property, you are usually able to get 75% loan to value on your deal,
Correct.
right?
Mm-hmm.
And that's usually considered sufficiently conservative. They're really conservative, like blue chip deals are usually at 65%, right? You're talking
Okay.
when insurance companies are buying, class A properties, they're going in at even lower leverage. But generally speaking, you're talking about 75%.
Okay.
However, when you refi, you can usually only refi at 70%. Now, I don't know why that is, but that's just sort of the way it is, right?
Okay.
And um, the uh, usually, right, you've got 5 years of runway and you've got rent growth and your NOI should be rising and the value of your property is rising. So even at 70%, what's supposed to happen is that even at 70%, you're able to refi enough that you not only cover the proceeds of the original loan, but you can actually return some equity to your investors, right?
Right.
Because you've had all
That's
that.
the idea. Yep.
That's the idea. If you've had all that rent growth. However, what the situation we're talking about now is because interest rates have gone up so much that even with the rent growth, there are going to be some operators who are going to not be able at the 70% level, they're not
Yeah,
going to be
no.
able to cover their original loan. And here's the other thing, I think we've talked about it on the channel in the past, but you've got some states in particular where insurance rates have gone through the roof,
Yeah.
taxes have gone through the roof. Texas right now, had been the poster child for multifamily. Now it's the poster child for multifamily pain. You've got insurance rates doubling and tripling, plus the way the property taxes are calculated in Texas is just a flat like 3% of value, and I believe they reassess every year.
Yeah.
So you've had, with all this run up, like the downside of
Mhm.
your run up of your equity is that your property taxes have gone through the roof, and combined with your insurance costs, that means that your NOI is really squeezed, plus higher interest rates. You're talking about, which is driving up cap rates, right? That all of that together means that the value of these properties may have dropped by quite a bit at the same time that interest rates are higher. So it may not be possible, even as a cash in
Yeah.
refi, to refi these deals.
Yeah, but let's just try to put some numbers on it, because again, I think people really, let's say you bought a deal for 100 million, just to try to keep the easy math.
Mhm.
And again, this would just be round numbers. You're going to get your first loan at 75 million. 5 years later go by. In theory, you're going to refi it at 70%. You would hope to get some NOI growth, some value growth, but that's just not happening today. That $100 million property, let's just say it dropped 20%. It's now worth 80 million. And oh, by the way, all these other factors, you're only going to do 70% of 80 million. So what's that, 56?
Yeah.
So roughly speaking, you're going to need a check for 18 million, assuming the bank wants to do the deal.
Right. Exactly.
That's not good.
No, no. And this, like I said, if this is a 2018 vintage loan that's maturing now, you probably are okay. You probably had enough rent growth over time,
Maybe
that you're kind of going to come around, come in sort of even. The real issue is for those 21, those loans that were issued in 2020, 2021, the beginning of 2022.
Yeah, 3-year
Those,
debt would be a problem.
yeah, if you had 3-year debt, which a lot of people did, bridge or whatever,
Yeah, not good.
or even if your debt is maturing in the next 2 years, right? Interest rates,
That's the big deal. I think it's the
yeah,
debt that's maturing in the next 2 years, because again, even if we just stay where we are, the appetite for all of these, and again, I said it earlier, if you're going to ask for money from your LPs, be first.
yeah.
Don't be fifth, because they're going to get very, very tired of those phone calls.
And listen, you've got, so I don't know if you've been following the saga of Tides Equities,
I
right?
did. I saw that.
Yeah.
Real Deal talked about it. I put it on the channel. They're asking for money from their LPs
Yeah, 20% of their deals have capital calls right now. And
already.
yeah, and you got to believe that that more is coming. And that was, that was a classic, like, those guys and their investors bought into the story that what was happening in 20
it was financial engineering.
was going to happen, was going to continue forever. The whole business model was based on,
yeah,
this time is different, right? Interest rates, these super low cap rates will stay low forever, and we're all going to make a lot of money because we're so smart. And look what happened, right? And they doubled down. They bought that whole portfolio at the absolute height of the market, expecting it to keep going, and now it's not. And now they're raising money just to cover,
they're limping along. Their classics survive to 25. Yeah. That's what they're trying to do.
But yeah, it's just, I mean, they're raising money just to buy rate caps, right?
Oh, not good.
Yeah, because their loans haven't matured yet, right? They bought 12-month or 24-month rate caps, and now they're expiring, and the price of those rate caps has gone from $35,000 to $1 million, right?
Yeah.
And
for the rate cap,
right? And that money is not going into improving the property, doing something that's going to raise rates and raise rents. I'm sorry, it's basically just going to buy time, right? And it doesn't guarantee that it'll buy enough time, right? Because
no, it doesn't guarantee. Absolutely.
Right?
That's what I'm trying to say.
Yeah.
Is there going to be people trying to buy over the next years, not realizing there's $1 trillion in people behind you trying to refi into an environment that's not going to be as open? Yeah. It's going to be bad. It's going to be a slow moving train wreck.
Yeah.
For 2 or 3 years.
I mean, I think though, what's going to happen is that a lot of banks are going to have to extend and pretend though, right? They're not going to have an alternative, because,
well, the Fed is doing that for office. I don't know if you saw that. I think it was over the weekend. The Fed put out some new guidelines about, we would like you to, what was the verbiage? Basically be kind to office debt, right? But give them some time. So.
Yeah. I mean, well, if the Fed is going to back it with like extending loans to those lenders, right, then to let them do it, then like maybe they will. But if the lenders have to pay back their lenders,
Yeah.
then that's a huge problem. And I think with multifamily, we'll see that where this is going to go. But I think a lot of banks are just going to be in a position where they 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 don't want to foreclose, because banks don't like to foreclose, right? They don't want to
Yeah.
own the property.
Oh, no.
They don't want to, if they're looking at a portfolio with, now they've got 20, 30, 40 non-performing loans,
Mhm.
right? Or loans that aren't really attractive to refinance, but they don't want to take them over, right? And they know
Well,
what happens before.
this is why this is something you and I talked about. I think the posers who thought this was a shell game or financial engineering, the banks that have that debt, they're going to force an owner. They're going to force an ownership change.
Yeah,
They're going to take out the GP and put somebody, because again, there's a whole Rolodex of the top 20 operators.
right.
I think get bigger in this environment. And a lot of GPs, first time, second time GPs are going to get just smashed and say, you're out of here. You don't know what you're doing.
Yeah, just get wiped out completely. And unfortunately, I mean, a lot of equity is going to get wiped out as well, right?
No, I
So
mean, you saw that deal in
yeah,
Houston, right? The 3,200
yeah,
units, 100
300
million in
units.
11 months.
Yeah,
That's
yeah,
that's hard to do. Let's burn $100 million in 11 months.
it's crazy, absolutely
Yeah,
crazy.
more of this stuff is coming. Jonathan, we thought it was coming. I knew it was going to be bad. This might be even worse than I expected. I'm excited because we got ready for it. We raised a bunch of dry powder. We are having relationships. We're building those now. If somebody wanted to follow your journey, where would they go?
Well, there's a couple of places if you would like to join my community. Come to apartmentinvestorsclub.com. You can get a free download there and get on my email list. Or if you wanted to just skip that and go right to investing, you can Google Two Bridges Asset Management LLC and fill out our investor form, and we will be in touch.
Awesome, buddy. Thank you so much. Great week.
Yep. Thank you.